Let me tell you about a deal we walked away from. And not just any deal. This one had all the bells and whistles. It was flashy, it was smart, and it was compelling on paper. The kind of deal that makes your eyebrows lift when you first see the teaser deck. You ever get the feeling that you want something to be true? Like maybe you were not consciously biased, but part of you is quietly hoping this might be the one. And I want to walk you through why we said no. Not just because it was a good story, but because it reveals something deeper about how real investors make decisions. The truth is, we don't get rich from saying yes. We get wealthy from walking away from almost good enough. So this deal came to us from a respected sponsor, someone we'd seen operate before. They had credibility, a few solid exits, and a decent sized platform. It was a ground up multifamily development in a fast growing southeastern city. I won't name which one and I won't name the sponsor. That's not how we operate. But I'll paint the picture. We're talking 300 plus units, Class A amenities, brand new submarket with buzz, strong demographic tailwinds, government incentives in play, and the IRR was 19 to 21% net of fees. On paper, gorgeous. So we did what we always do. We dropped it into the Infinity Engine, our AI powered deal screening tool. It passed the first gate. That doesn't mean it gets a yes. It just means, okay, worth our time. What the engine picked up, though, and this was subtle, was a softening absorption trend in the submarket. Not a crash, not even a red alert. It was just softness. That alone wouldn't kill a deal, but it was the start of a trend, and we started pulling. Let me show you what I mean. The sponsor was underwriting lease-ups in 11 months, stabilized occupancy under a year. But when our team pulled real comp data, the nearest comp was offering 2 months free rent. Another had hit 85% in month 16. Now, this might seem like splitting hairs. What's a few extra months lease up, right? But when you're modeling IRR, those months are everything. You shave 3 to 6 months off absorption, your cash flow shifts, your break even shifts, your exit timeline shifts. And in development, time is not just money, it's velocity. You lose velocity and your whole capital stack starts to wobble. But that wasn't the big one. The real crack showed up in the sponsor's pipeline. This was project 4, 4 active builds, same market, same time, same trades, overlapping teams. Let me tell you something we've learned the hard way. Concentration can hide behind momentum. Everyone wants to back a busy sponsor, the one with cranes up, capital raise, headlines made. But if one of those dominoes fails, the rest are standing real close. So we dug deeper, started calling the GCs, brokers, our local guy on the ground. You know what we heard? There was labor delays, sub-cost creeping, some whispers about subordination on vendor payments. And when you hear that even before drywall is up, it's time to walk. Now, here's the thing, and I want to be honest here. We didn't find fraud. We didn't catch them cooking numbers. This wasn't a scandal. This was a perfectly average moment in capital allocation. A decent deal, decent team, decent market. But that's what the trap is. Mediocrity wrapped in momentum in which portfolios die. It's never the obvious disasters that burn you, it's the almost good ones that do. The ones where you talk yourself into the upside, where the sponsor has a nice deck, where your team is split, where you think maybe I just do 1 million instead of 3. No, not us, because at Infinity 9, we don't invest to win the spreadsheet. We invest to multiply and protect capital over decades. That requires a different standard. And you know what the craziest part is? A few months later, after we had walked, the project got delayed. One of the other projects ran over budget. The bridge loan tightened terms. They pushed lease up back 2 quarters. Investors are still in, still hoping. Will they lose? Maybe. Maybe not. But will they hit 21 IRR? Never. There's no chance. And we slept like babies because we honored the process. We trusted the framework. We listened to the whispers beneath the noise. That is the game. So here's what I leave you with. The deal you say no to will define you more than the one you say yes to. Anyone can wire money when it's exciting. But the real investors, they say no. They protect dry powder. They wait for asymmetric shots. They will be tested, and I promise you will have deals that feel like it could work, a deal everyone else is saying yes to. And in that moment, you'll hear the whisper, does this deal honor my framework? If the answer is no, walk. And walking is wealth. See you on the next one.